Good morning, everybody. Welcome to another Daily Market brought to you by Mike Bjork. Today is Hump Day. It's Wednesday and it's August 29th. We got a couple items here, kind of important items here on the economic calendar. So we got the second look at the GDP for the second quarter of this year. And the initial reading came in at 4.1%. The forecast is supposed to remain at 4.1%, and it did go up to 4.2%. So good overall news showing the strong economy got even stronger. So we'll get the final revision in September, and we'll see for Q2, and then of course, then we'll start looking at Q3 come October, and of course that will be important to see how the third quarter went. Last but not least, we got the pending home sales for the month of July. So in June it went up 1%, and July it dropped 0.7%. So I don't know. There's not much I could say about that, primarily because we got low inventory. If we don't have the inventory to support the sales, we just don't have it. So unfortunately, in this scenario, it's not due to a lot of inventory out there and nobody's buying it. We got people out there buying. We just don't have the inventory to meet the demand out there right now. So home sales are still under 30. A lot of homes that are out there on an affordable level are selling less than 30 days. So that kind of tells you something there. So let's kind of jump ahead here to the headline news. Stock market is up. Nasdaq and S&P 500 are reaching intraday highs. They're reaching some. I believe they're at actually almost all-time highs right now. And then a lot of it is due to the agreement earlier this week with the Mexico, and then Canada sent one of their ministers down to talk to the administration, discuss potential agreements with trade between Canada and the U.S. So it looks like we're kind of seeing some less tensions from other countries. If you recall, we also met up with Europe, and they also came to an arrangement that they'll, that will come up. So the big one, of course, would be with China. Hopefully, that will be up and around November when the two presidents meet. So again, that's looking good. We got a strong economy. Inflation's kind of in check. And speaking of inflation, tomorrow will be the PCE, which is the Fed's favorite gauge for inflation, will be released tomorrow, and that will be a big one tomorrow. That could definitely move markets. Now, currently, the core, which is what they really look at when you strip out food and energy, is at 1.9%. The Fed's target rate is at 2%. So what happens when you look at the PCE or these inflation numbers? It's on a rolling 12-month schedule. So August of last year, it was up 0.1%, so that will go away. So if we go 0.1%, it will remain at the 1.9%. Or if it goes up 0.2%, that's the forecast. It's going to go up 2.2%. If that's the case, then that will bring us up at the 2% level what the Fed has us at. So if you recall, the Fed has said they're going to probably start looking towards being less accommodating in terms of their, even though you see rates going up, them raising rates, which September they're expected to raise another 0.25%, and then December they're saying if could be, but strong possibility that they will in December as well. So that would be a total of 1% that they grow this year. But the reason being is that we're basically at employment capacity. That was one of the things that they want, and then also the 2% inflation rate that they want to be at as well. So again, part of the reason for raising rates early is because if the market gets too overheated, this will help get the market too overheated. But if anything ever happens, if we go into a recession, which you see this inverted curve potentially happening here very soon, which is basically when the short-term rates are higher than that of the long-term rates, typically what we see is a recession going in. So if that happens, if we did not raise rates, what would happen is the Fed would have no tools in their toolbox to be able to try to fight that. So in this scenario, basically they could reduce rates to stimulate the economy and then boost the overall economy and get us out of the recession. So it gives them a little bit more tools to play with if something happens down the line here, which if that were to happen, we're probably looking at late next year if we were to go into a possible recession here. Let's kind of jump ahead here and take a look, see how this is all affecting the bond market. The bond market, as you see, we stopped right here at the 25-day moving average. It kind of put a floor here of support, and right now we're just pushing above it. We were testing it earlier today. Right now we're up 2 points from yesterday, so there's no change in our pricing today from where we left off yesterday. So again, no difference here. but we also got a double resistance here with the 100-day moving average as well as the 50-day moving average, which is kind of keeping us from going upwards as well. And then, but if you look here, we've kind of moved down. We had the crossover the other day. We're now getting back into the normal area where we should be at. So that's kind of helping matters as well. So it's potentially, if we drop below this, this will be important. If we drop below this and stay below that, we got a lot of room here that rates could worsen pretty quickly here. So be very careful here. If we could break above here, we got some room up here where you can, again, get a little reprieve and a little breathing room in terms of keeping the rates a little steady here. Here's the yield. It's kind of the same thing. We're getting back into this. We have the crossover here. We're getting back in the normal area here. We put a ceiling of resistance here. The 50-day moving average is putting a ceiling here, kind of resisting it. It's trying to break above it. Right now, there's no change from where it left off yesterday, which is right around the 2.88 level here. So again, we're just trying to keep this a cap on this, keep this from breaking above there, so that way we can mortgage-backed securities can do its magic and try to keep rates low for a while more. All right, so again, be cautious if you are out there and you're in the middle of a transaction as a purchase or refinance and have not yet locked in. Be a little cautious. You can float a little bit, but be quick to the trigger if it worsens, because it could be a lot of room where it could quickly change and drop and can go up quite a bit again there. So to be very cautious. If you guys want to get more data, just come over to Twitter. You can find me at Mike Bjork on Twitter, and I will post throughout the day, include any market changes that may affect interest rates. You guys have a great rest of your day. Thanks so much for watching. I look forward to see you guys tomorrow. Bye-bye.